Good morning, everyone, and thank you all for joining us today. My name is Fahd Al-Bashir, the Director of Investor Relations of Boursa Kuwait. On behalf of Boursa Kuwait, it's my pleasure to welcome you today to Best Practice IR and Annual Report Workshop, organized in collaboration with Instinctif Partners. The Middle East has experienced significant movement in the capital markets over the past few years, accompanied by changes in the structure of stakeholder engagements. One of the most important changes is in the field of the investor relations, which has become a crucial part of a company's overall strategy. Today, it's vital to have a clear, well-planned, and effective investor relation program that can help deliver and communicate the value of a company and build a strong shareholder base. The IR function is responsible for maintaining a two-way communication with the investment committee and is one of the ways companies can tell their stories, making sure they reach the right audience at the right time and through proper channels. Today's workshop will help explain how you can do that, as well as touch on a few key points such as an in-depth understanding of investor relations, developing a best-class IR program, cultivating stroke investor relationships, crafting award-winning annual reports. I am very pleased to introduce our key speakers: Matthew Smallwood, Managing Partner, Capital Market MENA; Samah Raghab, Associate Partner and Capital Markets and Investor Relations MENA; Dua Cannon, Consult Content and Creative MENA. So without further ado, please join me in welcoming Mr. Smallwood to the stage.
We are delighted to see so many of you here. But before we start, I must say a big thank you to Boursa Kuwait for hosting us today, particularly Priya and her team, which made all the organisation absolutely seamless. A quick plug for Instinctif Partners. We're one of the leading investor relations and communications companies in the region. I'm a founding partner of Instinctif and have been in the capital markets arena for around 35 years, although I don't really like to mention that much. I'm joined by colleagues Samah Raghab, and later on you'll meet Dua Cannon, who is an expert at corporate reporting. So let's begin. Why are we all here? To be an interface between our companies and its shareholders. What are we all trying to achieve? To improve or enhance shareholder engagement, to improve the way we tell the story, to make our investment cases more transparent, and to ensure compliance and governance. There are some other goals: optimizing valuation, increasing research coverage, and altogether providing better access to capital. So what are the challenges that we face? Up on the top left. Articulating the investment narrative, providing sufficient guidance to the market, internal politics that we all face, and I know it's one of the very big challenges, having enough resource to do your job effectively and efficiently. And how is IR changing? Once, and I remember it well, IR was seen as tactical and transactional, doing all the things on the left-hand side of the page on the screen. Liaison with shareholders, providing information, obeying the rules, providing the board with market and shareholder views, and engendering support should your company need capital. But that's evolving fast. IROs have become not just purveyors of information, but a strategic conduit, a master interpreter of critical business issues and metrics, the person who nuances guidance and is seen as a trusted advisor to the board. IROs are in charge of a company's brand equity, its reputation, and how a company communicates. And that is now transcending into a hybrid world of verbal and digital platforms. Most of all, IROs have become accountable for the value of capital, both existing and future. So what are the trends that are shaping our space? We all know of the first, ESG. It's been around for a few years now. And many exchanges now have a minimum requirement, and investors have a varying degree of investment criteria to measure it. This is here to stay, and the requirements will become ever more detailed. I also think that the onrush of passive investment throughout the global markets, driven by algorithms, sometimes uninfluenceable, or perhaps they're not. Advanced digital tools to make it easier for investors to analyze companies. And of course, the growth and impact of ChatGPT and AI. And on the next slide, I'll talk about how that will impact all of us. And AI are becoming more and more recognized and valued roles within companies and within boards, and its central role in decision making. So back to AI. It's a hot topic, and its full impact is still emerging. Used correctly, it's a fantastic tool, bringing efficiencies and strategic focus. It's being used more frequently by our IROs for drafting announcements, understanding market movements and sentiment analysis. The importance of AI can be seen in investors' enthusiasm for artificial intelligence, which has propelled the US equity markets to reach an all-time high multiples in early 2024, and that continues even today. The strong outperformance of AI-related stocks, particularly the mega caps, has some market watchers asking if this could be similar to the dot-com bubble that burst in 2000. I think not. Hedge funds and other trading operations utilize artificial intelligence at a very high level, as an example, to gain the slightest advantage in fast-moving markets. But artificial intelligence is also widely used in finance and investing because of its ability to process and analyze information from very large data sets. Further, artificial intelligence can be used to help choose stocks, make predictions on market movements, optimize portfolios, manage risk, obtain personalized investment advice, manage trade entry and exit strategies, and automatically build a customized portfolio that meets specific investment criteria, such as risk tolerances. Artificial intelligence allows investors to efficiently sort through this data to identify stocks that meet their criteria. Stock screeners have become important and are sophisticated tools that allow investors to filter stocks based on criteria that can include fundamental and technical data points, such as accounting ratios, market cap, trading volume, and moving averages, to name a few of the literally hundreds of data points available. And just as an aside, one of my children, my son, has recently joined a hedge fund that is backed to the tune of $1 billion by Northrop in the US. And he has spent the first 6 months of his working life there learning code, creating algorithms that will find things in annual reports that no one else would see. So he inputs data, it all gets agglomerated, and even the slightest variance from year to year in the annual report, in the way that you deliver it, will be recognized by that hedge fund, and they use that information for trading. AI will eventually become part of the IR toolkit. It's going to augment what we all do. It's going to make the application of technology and the ability to give answers that are customized to investor segments much more powerful. Just like we have operator assisted calls and press releases This is going to be an augmentation, not a replacement. It's going to make IRO's capabilities significantly more powerful regarding how IROs deal with specific investor groups and stakeholders. It's all about AI's ability to focus on all things that are not relationship linked. All the tactical elements, the administrative aspects, the kind of high-level analysis, being able to automate all of that so IROs and their teams can focus more on the relationship side, just made it starkly clear what the future of the IR investor relations business looked like. AI doesn't replace the human element and never will. It enables teams to have much more capacity to focus on what matters most, which is the relationships that they have with their current and hopefully new investors. And then there's the increasing trend of ESG in all of our lives. It's become a key focus with differing levels of reporting required in different markets. Environmental, social, and governance investing has experienced a significant rise in recent years. It has transitioned from a niche investment approach to a mainstream strategy embraced by investors and businesses worldwide. In the region, starting 2025, the Omani exchange, the MSX, is mandating ESG reporting. And this is likely to be replicated in other markets if there is nothing in place already. But ESG is not just about reporting. It's about really doing and implementing strategies, not just ticking boxes. Some companies' reputations have been severely damaged due to greenwashing. ESG assets surged to over 35 trillion in 2022, representing an increase of 15% compared to the previous year. That trend has continued, but not quite at that rate. Nevertheless, it is really important to all of us. The rapid growth of ESG investing can be attributed to various factors, including increased awareness of global sustainability challenges, heightened regulatory scrutiny, and the recognition that ESG factors can materially impact financial performance. Investors are increasingly recognizing the need to incorporate ESG factors into their investment decision-making in order to mitigate risk and to contribute to a more sustainable future. 85% of investors now believe that ESG provides benefit to their investment decisions and overall enhances returns. My colleague Sama will talk in more detail about this important topic later, and I would now like to hand over to her as she talks through the nuts and bolts of building an IR program and other things.
Assalamu alaikum, everyone. It's a real pleasure to be here today and to see amazing capital markets professionals like yourselves. Before I start, I was just saying to the gentleman here that Kuwait holds a very special place in my heart because the very first step in my not very, very long career journey has been with National Bank of Kuwait. And it has been a real pleasure to look at the Kuwait stock market back then and to see amazing developments happen. So one of my clients back then, I used to be a sell-side analyst. We used to cover real estate stocks in Kuwait. And two of my largest clients were Mabani and Salhia Real Estate. And I remember when the Avenues Mall was in the very first stages of its execution and how amazing it has become right now. It's amazing to see the level of progression that the entire country is going through. And it feels that I was a little part of that, seeing it unfold over time. So it's a real pleasure to see you all here today and to see the great progress that's been happening in Kuwait over the few years that have passed. So back to the main topic that we're here for today, investor relations. what we'd really like you to take away from our presentation or workshop today is that let's try to think of investor relations in a different context. Let's try not to think of it as a mandatory task that we need to do to just check off something on our laundry list of things. So, as Matt was saying earlier, there are so many goals and so many challenges that investor relations officers face every single day. And if we think about it more deeply, we will come to realize that the market is rapidly changing. The investor relations function itself is growing at a very fast pace, and it's very, very quickly evolving to include so many elements like Matt was saying, AI, ESG. It almost feels like every day is a completely new day in the life of an IRO. So how do we really establish the building blocks that will enable us as listed companies to take our investor relations functions forward and to keep up with the really amazing race against time that's happening every single day? So how do you build a successful and a best-in-class IR program? Thinking of investor relations, like I said, is not something that we need to consider in a very traditional ways of thinking or implementation. So let's try to move away from the idea that investor relations is only related to financial reporting. So when you build your program, think about all of the other elements of the year, all of the other periods in the year that do not involve earnings, because in fact, all of the off-season or all of the off-earning season periods are the most critical periods that will really help you engage very closely and be recognized in the market as the companies that are doing real investor relations. Okay? So the whole program will not involve, like we said, just financial reporting, but think about all of the other things that you want to focus on to enhance and to maintain consistent and open lines of communications with your various stakeholder groups. So the first step is to really think about how you align strategically as a critical function within the organization and integrate with all the other functions within the company. So think about how you want to engage your internal stakeholders. So one of the main success factors of an IR program is when you collaborate and integrate really well and get your management buy-in. Because when you get your management buy-in, that's the first step in driving the success of your IR program. Because that also helps you align your strategic IR goals to the overall corporate goals of the company. And this is the tangible message that you want to convey to the market, that your IR function is working very well and working in pace with the overall company's strategic vision and mission. Another important aspect that we need to think about as well is your IR calendar. What does your IR calendar look like? How do you want to plan ahead of time? How do you want to be proactive? Go out there, meet your investors, engage in one-on-one conversations, attend investor conferences, be there. You want to be there. You want to be present. And believe it or not, even with the pandemic and the many trends that are shaping the way we collaborate as human beings with each other, believe me when I say the human element and the human interaction side of things will be here to stay. No matter how much the world is changing and technology is advancing very rapidly, it makes all the difference in the world when you spend the time, you as an IRO and your management teams, and travel, go out there, sit with your investors, give them your precious time. That is something that they will value for sure, much more than just talking to them on a laptop through Microsoft Teams. As much as the world is changing, the human interaction will always remain as a very important part of how you interact with your stakeholders. Transparency. That is something that we cannot emphasize enough. As much as you try to be proactive and engage and go and meet your stakeholders, think about how you want to be known as the company that is transparent, the company that has nothing to hide. During good times and during challenging times, we will convey to the market everything that is happening with our business in a very open manner, because this is something that investors and analysts value a lot. Everyone will obviously feel comfortable and happy to talk about the great successes and triumphs that have been happening. But then the real question comes when times are changing, when you're navigating challenging times for your business with different headwinds that are happening that are impacting you. That is the real test of your relationship with your stakeholders. So please maintain transparency throughout, especially during challenging times. And finally, when thinking of your IR program, just like any other project that you have, go back to the days when you were a university student and you were tracking your progress. That is the real measure of how much success you've been achieving. So this is pretty much the same when it comes to investor relations. You cannot really say proudly and happily that you're being successful when it comes to your IR program without implementing real measures of success and key performance indicators and tracking those over time. And then after thinking about your fabulous investor relations program that you'll put in place, how do you do that? How do you achieve that successful stage that you want to be in? Let's think together of the many tools that we have at hand and think about them more as enablers rather than tools that will help you drive your program even further. Some of these tools include how you want to enhance your stakeholder engagement, how, like we said, you want to improve the disclosures that you have and enhance your credibility over time, and of course, maintain compliance with all the necessary rules and regulations in the market. And when you think about these tools, think about them in a very comprehensive manner. So one of the key things that need to be considered are share register analysis and perception studies. Without keeping a very close eye on the different movements that are happening in your share register, it will feel like you're in the dark, like on your own. There is something that is happening in the market that you're not aware of. So keeping a very close eye on your share register analysis is the first step in understanding how the market perceives your company. What are they looking for? Why are they invested in your peers and not in your specific company? And tie that with investor relations perception studies. So you want to hire a third party, a company that will provide anonymity to the respondents and will help you understand the trends that are shaping the perceptions of the market. What do people like about your company? What do they think your management team is really good at? Where do they think the company can improve? Maybe you have more transparent disclosures, maybe participate more actively in investor conferences. So this gives you a bird's eye view of what's really happening. And again, a key point to remember here is, of course, you cannot conduct the perception study directly by yourself as a company, but when you work or collaborate with a neutral third-party organization, this will really provide real value for the insights that you will get from your perception study. In addition to that, one very important thing that is necessary to be thought of is benchmarking against your peer or benchmarking against industry-leading organizations. So like we were saying, as an IRO, you need to always keep up to pace with what's happening in the market. What are your peers disclosing? How are they engaging with the market? What are the events and the conferences that they're in? How is their communication strategy shaping up? You need to think about all of these things through your comprehensive benchmarking, and this will help you understand where you stand relative to your peers and where you can improve. And then the final and the ultimate goal is for you, like I said, to derive real value from your IR program. And your stakeholders need to feel the same. They need to feel that every single engagement that they have with you as an IRO or with the management team is a real investment of their time. Okay, IR calendar. We spoke about this a little bit earlier today in brief. So again, your IR calendar is essentially the first step in how you're going to pave the way for the rest of the fiscal year. So think about how you want to engage with your stakeholders, particularly your investors and analysts. How do you want to show them that we are not just a company that comes in, talks about financial results, and that's it, and we disappear for the rest of the quarter? Always maintain the momentum. The most important thing to be at the top of the mind of all your investors and analysts is to be there. Be with them, like we said earlier. Meet them in person. Plan how you want to engage with the sell-side analysts as well. Because when you think about it, this is the group of people that are essentially those that are marketing your company, if you think about it. These are people that you need to have on your side. I'm not saying that you need to influence their opinion about your company, but your sell-side analysts are a very important group of people because it is through their valuations and their opinions about your company that investors are encouraged and enticed to put so many hundreds and thousands of dollars in your company. Think about also other things such as very important events like your annual general meeting. Be proactive. Try to anticipate what are the kind of questions that your investors will ask you during your AGM. And this will only come with time. And when you really get to a point where you build a very strong relationship with your investors, believe me when I say that you will expect the kind of questions that they will ask you. And you will walk into that AGM comfortable and knowing what to expect. So it's not always about how much dividends you're going to pay them. It's much more deeper than that. So be proactive, anticipate what's coming, be there, be present, and see them in person, like I said earlier. Two other very important things that I would like to highlight for you today are capital markets days and site visits, which Matt will take us through in much detail. So just very briefly, a capital markets day is a day or two where you organize something very special about your company. Let's think about it as a field trip for your investors and analysts. So you're inviting them over to one of your company facilities or one of your sites, and you're taking them through your journey. You're telling them, why are you a great company? What have you achieved? What is yet to come? And what is yet to come is the $1 million question that will really encourage them and motivate them to invest in your company as time goes on. And one very important thing when you think about these one-on-one interactions, when you go and meet the investors or when you invite them for a capital markets day, is the sense of closeness that you have with them. The fact that your management teams are sitting in the same room with your investors. That very close and direct interaction is something that investors will value a lot. And they will remember you for it, especially because, as Matt will tell you in a short bit, not many companies in the MENA region host capital markets days. But when they do, everyone talks about it because it's not a frequent occurrence. Another platform where you get to speak to your investors and your analysts directly are through earnings calls or meetings or one-on-one engagements. And you look at your investor presentation. So how do you really master the investor presentation? How do you reach to a point where people will walk away from that meeting with you feeling that they have invested the best time in their lives? How do you achieve that? So when you think about the investor presentation, think about it as the channel or the broadcast channel that allows you to convey so many pieces of information to a group of people at the same time. So some important tips that you need to consider are the very first step in the investor presentation. How do you start your presentation? Remember, first impressions last. Us as human beings, when you go and meet a new friend, when you're getting to meet someone for the first time, you will never forget the first impression you have of them. Even after so many years, that first instance, that first day you saw them, that is something you will never forget. So in a similar sense, the first step in the investor presentation, your opening to the presentation, that is something your investors will not forget. So remember, you need to have a very catchy introduction, meaning you need to captivate your audience from the very start. You need to engage them throughout, and that will only be achieved when you have a very strong introduction. And when I say a strong introduction, it does not mean that you need to use very technical or sophisticated words like us financial professionals love to do. Let's avoid that. Let's make things a bit simple. But what I mean is have a strong introduction, something that will be in the minds of your audience for a very long time. And think of the overall structure of your presentation. It needs to have a very organized structure. It needs to have a very logical flow to the ideas that you want to present to them. And in addition to that, like we said, let's not complicate things. Life is complicated enough for everyone, right? Let's not add another layer of complications. So let's take it back to basics, especially when your business is like consistent of a complicated business model. There isn't really a huge need for you to, put tons of technical terms just so you come across as, a very experienced management team. Believe me, it doesn't work like that. Okay, so let's be simple. Let's stick to the basics, and let's think about the audience. What does the audience want to know? What is the ultimate objective of this presentation, right? So speak the language of your investors. Speak the language of Wall Street, as people say, right? When you speak their language, when you put yourself in their shoes, that's only when you really achieve success out of your presentation. So speak their language, highlight your strategic initiatives, and not just talk about strategies on paper. Show them what your strategy really means. How are you achieving that strategy? And over time, how you're progressing against that strategy. Because remember, when you say something to the market, it's almost like a commitment. You need to keep your word because they will remember you and they will take you for your word. So today, for example, if you speak about a very huge, strategic framework that you're planning to undertake as a company with some specific targets that you're planning to achieve, remember that the targets that you're saying to the market are things that they will remember forever. And they will ask you about them time and again. So your word to the market is a commitment. So let's please keep our commitments to maintain that level of trust and credibility with our stakeholders. One of the really interesting techniques that I personally try to use as much as I can when I present is storytelling. Matt has used that technique earlier when he shared a personal story about his son. Storytelling is something that I cannot emphasize enough. When you tell people a story, when you share with them an analogy, when you share something personal, that is when they will remember what you said, because human beings are wired like that. We like to hear stories and we like to sit and talk with storytellers. So weave a compelling story, have something interesting to say. It doesn't need to be in the very formal way of things, like a regular presentation where you're just talking from a one-way perspective and that's about it. Tell a story and make sure that your story is compelling and interesting enough to get the investors, or rather potential investors, to put that money in your company quite comfortably. So storytelling is very important. Your IR website. So your IR website is essentially the main channel or the main communication channel that you have with your stakeholders. Because think about it this way. The first thing that comes to mind when you want to learn about a company is to go and see their website, right? That's the main channel that you will look out to. Your IR website tells your story. As we were saying earlier, you want to tell a story. So your IR website tells the story of your company. Your IR website tells the story of your people, the people behind this great company and the successes that it's achieving. So showcase your management team, their experience, tell your story. The most important thing is to really answer the question of why invest in my company? Why should people put money in your company and take that risk? Show them that. Show your investment case or your equity story very prominently on your site. Talk about what you're doing when it comes to ESG. Matt spoke earlier about the importance and the rising importance of ESG. What are you doing in terms of ESG? What is your ESG framework? What are your goals and objectives out of your ESG program? You need to showcase that. And remember, we do not want to greenwash. So it's very nice and easy for everyone to say we will cut carbon, emissions by 50% in the next 2 years. But will you? Will you really do that? Think about all of that. And of course, one of the other, key sections that you need to have in your IR website is, of course, the financial information, updated financial information, and most up-to-date news about your company. What's the company been up to? What is the company planning to achieve, etc.? And of course, your IR calendar, which we spoke about earlier. So your amazing IR calendar that sets you out for the year needs to be sitting on your IR website so people know what you're planning to do. And that will also drive better and closer engagement with your stakeholders. Because, for example, if a fund manager at a global institution is planning to attend conference ABC, let's say in London in August, for example, they know that you're going. This will be the trigger for a new conversation. They may reach out to you, you may reach out to them and go and see them there and really create, like we said earlier, tangible value out of your interactions. One very, very important thing that we also need to think about when it comes to our IR website is navigation. Please, we're not in it for a jigsaw puzzle game. Remember, we want to find things easily. Everyone is so busy, and people's time is obviously precious. So let's make it simple. Neat and clean design that is visually appealing, and navigation is important. I, as an analyst or an investor, need to be able to quickly get to the information that I want and download it very easily. So remember, we're not playing a game of jigsaw puzzle, please. Let's avoid that. So, remember we spoke earlier about management buy-in into your IR program and IR initiatives. So, how do you really get management buy-in? If your management team is out of sync with what's happening in terms of your IR progress and achievements, how will they be encouraged to support you? So, internal reporting is one of the most important factors in an IR program. So, keeping your management teams regularly informed of what's happening on your IR program, who are the great people that you're meeting, what are the outcomes out of those conversations? Are they turning or converting into real investors into your stock? So that's a measure of success, for example. What are the priorities for the IR program the management team needs to understand? Because remember, when you engage your management teams very closely and get them to invest time in your IR program, your stakeholders will really value that, because everyone knows how much a CEO of a company or a CFO is very busy with 100 things to do, right? But if you report to them, on a constant and a regular basis and get them to invest some of their time in an effective and efficient manner, that will add much more value to your interactions with your stakeholders. Because remember, your stakeholders' time is precious, and the time of your management teams is equally precious. So you want to engage your management teams, not at all times, because that will be impossible, but you want to engage them on an as-needed basis. But in order for them to be really encouraged to help and support your IR program, they need to first understand what's happening. So internal reporting is very important to get the management buy-in and to derive real and tangible value for your IR program. And at the same time, when the management team becomes aware of what's happening, they will support you even further. Perhaps when you're setting out or embarking on a new journey as an IRO and you're building your IR team, they will provide the necessary resources if they feel the need for it. And at the same time, when you have the management's views on what's happening in terms of IR and you show them what your ultimate objectives and targets are, it means that the objectives of IR and the objectives of the company are very strongly aligned. And that's another real measure of success. Pure benchmarking is something we spoke about earlier. So just very briefly, benchmarking against industry-leading organizations, like we said, is very important because you want to know what's happening in the market, especially in areas where the company can improve its performance. So the insights that you will derive from this very useful exercise will feed into how you roll out your IR program and how you want to change things, perhaps change your communication strategies with your stakeholders, perhaps think about more disclosures, maybe more disclosures at the segment level for your company where other peers are doing it and you're not, etc. Or perhaps think about, I don't know, conferences and other key industry events that your peers are attending and you're not. So very valuable exercise that will help you get so much value. Perception studies, like we were discussing a little bit earlier. Again, of course, the perception study cannot be conducted by the company, but you need to work very closely with a neutral third-party expert that can provide you with that useful platform, where a group of stakeholders are selected, both from the buy side and the sell side, and their views on the company and on different elements of the IR program are gathered. So, for example, a typical perception study, like a lot of ones that we do for our clients, for example, will cover so many different elements and many different themes that ultimately lead into providing valuable insights to improve the IR program. So, for example, some of the things that a typical investor perception study that we do will cover things such as the quality of the management team. Do stakeholders feel that they are getting quality interactions with the management teams when they go and meet the CEO of a company? Is that meeting fruitful? Have I learned something new? Have I learned something that will make me think I want to increase my ownership in that company or not, for example? Think about the quality as well of your IR disclosures. What are you disclosing to the market? What are you withholding? Think about your capital allocation frameworks as well. So, are we on the right track? Is the new investment in company ABC in Europe, for example, is that a smart move by the company or not? What do your analysts and investors think about that? What do they think about where you're heading in terms of your ESG program? Where do they think there are areas where you can really improve your IR function? Where do they think that your strategy is working well? And where do they think, no, maybe that wasn't a smart idea? So in other words, your perception study will give you a holistic overview of the entire company, be it the management team, the IR team, your ESG agenda, your capital allocation framework, and your strategic direction as well. So the insights that you derive from this valuable exercise will really tell you, where can I improve as a company? Where can I be recognized as a leader in my industry when it comes to investor relations and managing the company as well? When you think about share register analysis, you need to constantly have a very close view on the share movements that are happening in your company. Who is entering your stock? Who is exiting? And why are they exiting? Why are fund managers, for example, investing in your peers and not in your company? What am I missing as an organization? What can I do better? All of these answers will be given to you through this very important exercise of analyzing your share register. And through the analysis of your share register, you can undertake a smart investor targeting strategy, meaning you can be very proactive in terms of who are the investors that you want to target, who are the people that you want to go and meet and speak to, and essentially tell them why invest in your company. So one of the key objectives and one of the key goals when it comes to investor targeting is you want to ultimately have a loyal, a long-term, and a sustainable shareholder base. Because when you achieve that, you will achieve typically a much fairer valuation for your company. And these are the people, like we say in plain terms, these are the people that will stick with you through thick and thin. So when you ensure that you have a loyal shareholder base, even when times are changing, when things are becoming challenging, they will stick with you for the longer term. But you need to be smart about how you target them and proactively reach out to them. I will not dwell much on this because Dua is the expert here on this one. She'll take you through a whole session on how to ensure a best-in-class annual report. But again, your annual report is another channel through which you're talking to a large group of people at the same time. So your annual report, again, will tell a story. So stories are with us throughout, remember? We always want to say stories, say them well, make them compelling, either through presentations, through annual reports. So all of these are just tools that will help you tell your story, that will help you tell people why they need to go and invest in your stock right now. So through your annual report, you are showcasing your management team. You're showcasing their expertise. You're showcasing your strategic goals as a company, what you want to achieve in the future. Because remember, investors are buying your company only partly because of what it is today, but more importantly, for what it will be like tomorrow. It's the future that drives the value of a company, much more than the present. Okay? ESG. We all keep hearing about ESG the whole time. It's becoming, I wouldn't want to say the new trend, but let's think about it differently. When we think about ESG, we want to integrate ESG across all functions within the organization, within IR, within finance, within human resources, within IT. Every single function in the company needs to have the ESG program integrated into it, because only then you will achieve the real objectives of your ESG program. And when you think about it, it's like a process. So the first step in the process of establishing your ESG framework is to first think about where you stand, or what we call the ESG maturity assessment. So you start by first assessing where you stand in terms of your ESG practices and disclosures relative to your peers. That sets the ground for you to get a better understanding of what needs to be done. So that's the first step. The input from this stage will then feed into the next stage, which is called the materiality assessment stage. So the materiality assessment, in very simple terms, is where you will be able to identify the most pressing or the most critical issues for your organization when it comes to ESG. And not just for your organization, but for your stakeholders as well. That is your materiality assessment stage. And through that, you will be able to identify both the risks that you have, especially from an ESG perspective, as well as the opportunities that you have as a company. And following that, from the materiality assessment stage and the ESG maturity stage, you will get a much more thorough understanding that will help you develop your ESG strategy. So through your ESG strategy, I would say this is perhaps the most important stage in terms of your ESG journey, because this will guide what you're planning to achieve when it comes to ESG. And what are the objectives and the way forward when it comes to your ESG initiatives as well? And again, why the ESG strategy is important is because it showcases to your audience, to your stakeholders, the value that the company provides apart from financials and dollar amounts. What are you contributing to society? How is your business impacting the environment? How are your governance frameworks shaping up? All of these are key questions that need to be answered by your ESG strategy. And then finally, after you have developed a very comprehensive ESG strategy, the final stage will be the ESG reporting stage. So this is where you will publish a very nice looking report where, again, you're telling your ESG story. When I told you earlier that stories will stay with us for the longer term, I really meant it. Okay, so you are telling your ESG story through the ESG report. And we've seen with a lot of clients that we have across the MENA region that it is, again, very important when you develop your ESG report to ensure that what you're committing to the market are things that you will really achieve. Again, remember, we want to avoid greenwashing at all costs because it takes so many years to build a reputation and to build trust with your investors, but it could take only one instance of one mistake, and the trust will no longer be there. So let's maintain trust. Let's be proactive in how we engage with our stakeholders, and let's think about them more so than we think from our own perspective. And with that, I'd like to hand back to Matt, who will tell us about how we can have an amazing Capital Markets Day, which is another very important channel of direct engagement with stakeholders.
I've been doing this a long time, and I learned a few things there. Very insightful. One of the impactful tools in an IRO's armory is a Capital Markets Day or Investor Day. Done well, it can furnish both buy and sell side with new perspectives and a more detailed understanding of the potential of a business and why they should recommend it or even invest in it. The advantages of holding Capital Markets Days are many. They provide more insight and data points for those interested. They can frame narrative around particular topics. They can answer questions that have previously been a concern to the markets, demonstrate the strength, experience, and depth of management, showcase competitive advantage, and enhance transparency and update guidance. CMDs in the GCC are not as common a practice as they are in other parts of the world, but are becoming more frequent. We were involved in a CMD for Saudi Arabia's leading health and fitness business last year, Lijam. The reason why they held it was that they were demonstrating rapid growth while their global peers were still recovering from the pandemic, and they wanted to highlight their differentiation. So they put together a half day of presentations for investors and other stakeholders. The chairman introduced the Minister of Sport for Saudi Arabia, who talked about the sporting revolution in the country and how the government is supporting it. And an industry expert talked of global and regional trends. And then Lijam explained how its strategy fitted into all of that. It was a totally integrated presentation. About 200 people attended, mixture of shareholders, potential shareholders, people who were supporting the Ministry of Sport, some dignitaries, etc. And what it achieved was that Lijam's plans were more formally understood, and people bought into their narrative. And those who were new to the story were educated and given context. Not only company context, but market context and kingdom context. The end result was that it was received very positively. It attracted many shareholders, and the share price rose 17% in the subsequent days. Clearly, the objective had been achieved and that value was added. But be under no illusion, CMDs are really hard work. Like earnings on steroids, and really intense. How do you ensure success of your CMD? You need a reason and purpose to hold one. You need to be saying something a little bit different to what you say in your normal earnings calls. The logistics need to be thought through in minute detail. These are long sessions that need to go well and need to captivate people's attention. And with that, there needs to be compelling content that builds into a conclusion with topics that educate and deepen knowledge. All of the speakers need to be trained and rehearsed as what they can and what they can't say. In most CMDs that I've been involved in, there have been a number of non-board executives involved in it, either heads of division or people who have specialisms in parts of the businesses. Now, they are not normally, they don't normally really understand the ins and outs of what you can and can't say. They need to be educated and told. And the invitees need to be carefully selected. There's no point in doing one of these things unless you can have a full and useful audience and a mix of existing, current shareholders, sell side, and other people who can influence the value of your business. And we would say that success can only be judged through a comprehensive feedback exercise post the event. In my experience, when one leaves this type of event, everyone says, yes, that was absolutely fantastic. Well done to everyone, and it was a brilliant thing. But actually, if you go around and speak to them afterwards in a considered and logical way, and have a set of answers, set of questions, then it's quite interesting. Some themes will come out of that exercise, and once again, you're not only interacting with the people who were there, but you get valuable insights. Some tips. Don't use too much jargon. Don't assume too much knowledge, and be creative in the way that you bring your story to life. Listening to individuals, speakers, for 4 hours or longer is very difficult. I think we've probably been going for an hour here, and we need to make it engaging. So use videos, use panels to break it up, use Q&A sessions, make it interactive. What will impress? A new announcement on the day, maybe. In Lee Jam's case, actually, they didn't make an announcement at all that day. The company didn't, but the Ministry of Sport did, which was fantastic. And that clearly was an integrated approach, and the reason why we held it when we did. Total clarity of strategy and progress of the company. Investors like a journey. They like milestones to meet so that they can benchmark and measure companies' progress. The clarity of that message is absolutely paramount. Companies need to demonstrate a thorough knowledge of the markets and where your company sits within the competitive landscape. One of the things that I've found that investors always do, they do their own peer group analysis, and they don't just do it locally, they do it globally. And you have to demonstrate a business model that is proven and works. And as Sam has said a number of times, it's all about highlighting the potential of your business. A CMD is one way of beginning or building relationships with investors, but there are many other ways to engage with the investor community. It all starts with external information, word of mouth, or maybe a market screener that has highlighted the merits of your company. So the website has to be fit for purpose. Your Google News page, and you need to communicate with the communications department for that in your businesses, should show relevant and positive stories. If one was to do an analysis of what investors do first up, when they find a potentially interesting company, they go on your website and then they go onto your Google News page. It's a ready reckoner of, and should paint, a picture of strategic progress, information, etc. Once engaged, you need to demonstrate integrity, honesty, knowledge, expertise, understanding of their requirements, and then continue to deliver through set-piece events such as earnings announcements, one-on-one interactions, broker conferences, site visits, etc. The long-term benefits of a sustained, best-in-class program, as we've spoken of today, are strong relationships with support, either when things get tricky or for additional funding and introductions to new opportunities. So how do you build trust? Transparency, as far as you can go. We all know there are rules and regs. And consistency, honesty, and integrity, and a respect of their time. It's a two-way street where you can tap into their expertise. They see more companies, a lot more companies than any of us in this room do, can bring ideas, have seen different situations that we all have, can address issues that they've seen elsewhere, and can introduce you and your companies to opportunities and help with smarter decision making. But this will only happen if their expectations are managed, they're kept regularly informed, and they feel as though they're in a partnership with you and your management team. This is, of course, tested when a company goes through challenging times. But if there's trust, there will be support. Ideas for solutions to a particular issue, and additional capital should it be required. There are some golden rules on how to develop that successful partnership. Have a plan for each major investor. Be knowledgeable about why they've invested. Be proactive with updates, market events, regular meetings, etc. Take their feedback seriously. Take their feedback really seriously. Action it, or if not, explain why. Ensure there is momentum to those relationships. So how does one succeed? Get agreement internally on benchmarks, KPIs, and objectives. You know what investors want. You know what they need. Get permission to use those things from your board so that you're all telling the same story. You're all speaking the same language, and you and the board, when you interact with investors, answer questions in the same way. One of the great failings of one of the great tools of investors is to ask an IRO a question and then ask the chief executive the same question. And if there's a differing answer, then a little bit of trust is eroded. Utilize the most modern tools. Scour the world for the best-in-class websites, the best-in-class digital tools, the best-in-class engagement programs. Find out who are awarded the best-in-class IR awards. Then go and have a look at what they do. That will help you. And begin to use AI to make the function more efficient. have a measurable and effective integrated ESG strategy, deliver consistent, and when I say consistent, one of the great bugbears of investors, in my view, is when companies keep on changing the way that they present things. What they like to do is measure year on year, quarter on quarter, and so they can evaluate. As soon as you change those metrics, they can't do that. And understand what investors really think and what needs addressing on an individual basis. Understand their issues and misconceptions. Understand who really owns the company. And Sama talked about register analysis. That's not just about who the nominee companies are. That's about the ultimate beneficial owner of the shares, because ultimately they will make the decision, and find out which fund they're in and what that fund, that fund's criteria are. And continuously target new investors to build appetite. You may be very happy with your register as it is, but that register will change over time regardless who you are. So you always need new demand. But overall, and it's demonstrated here on the right, that the route to success is to build relationships. Ensure that you're supporting a strong management team, that you're in the loop by being part of the board conversation, and deliver accurate financial information and guidance. And how do you measure that success? Very important for all of you. There are many ways, some quantitative, some qualitative, and they're on the screen. This is an ongoing process, should be part of the IR quarterly board report, and shareholders can be surveyed about efficiency and quality of the IR department. So Samo talked about perception studies. Some of it is about their views on the company. Some of it will be about their views on the management, but some of their views will be on how companies can improve their interaction with their owners. That can be measured because shareholders can be asked to give a 1 to 5 score on any topic. And that measurement can be put together into a report and shared with your board to show year-on-year progress. One thing we have learned is that IR is a long-term game and a continuous process and a continually evolving process. Measuring success can be challenging as the typical measures used to gauge success are impacted significantly by matters that are outside of your control. Financial performance, macro issues, etc. So what makes great investor relations? We like to think of it in a pretty simple way. 5 C's. You'll have heard this throughout the deck, and Sam said it a few times, and I've said it a few times. Be consistent. It'll really help you. Really, really help you. Be comprehensive. Be detailed, without compromising the simplicity of the narrative. Tell the whole story, even the less appealing parts. It will help with trust. Be clear. Use language. Don't assume too much knowledge. And bring your story to life with case studies. And finally, show unwavering commitment. Be proactive, responsive, nimble, adaptive. I thought a good litmus test to conclude were the quotes on the right, which come from a company to investors and demonstrate the level of respect that should be due between the two parties. It's never okay, this is from a chief executive, it's never okay to ask what a company does or to be unprepared for a meeting. And if you do that, then I'm not prepared to give you my time. If you do that, then all parties will benefit. I hope you've enjoyed the presentations. I think we're taking a quick break now, correct? And then Dua will come back and tell you all about how to make your annual report the most fantastic thing ever.
Hello, everyone. Welcome, and thank you for being here. I would like to start off with a question. So, have any of you worked on an annual report before? So, most of you have. And for those who don't know, I'll take you through annual reporting, specifically best practice annual reporting. What is a best practice annual report? So best practice annual report is not only storytelling, it's also engaging design. Design and storytelling work hand in hand to produce best practice annual reports. Maybe some of you have heard about a report winning an award, either in digital or print. So I will take you today through this criteria that is specified for both digital and annual reports, print annual reports. And first, I would ask you to consider an annual report not only as a document, but as a story. So it narrates the story of your organization, the achievements that you've done throughout the year, your company's vision, and how that vision comes to life through storytelling and engaging design. So this criteria is set by MIRA, which is the Middle East Investor Relations Association. And the last MIRA conference happened in Bahrain in 2023, where they announced the best practice winning annual reports for the 2022 season. And that criteria is divided into, first of all, we have general criteria. We have those focused on design, those focused on content, digital, and also sustainability. So firstly, when it comes to any annual report in general, what guidelines do you look for? You want to make sure it flows well. So in my opinion, the fastest way to set up a good annual report apart from a bad annual report is how it flows. So you want the sections to be coherent. You want the chapters to be coherent. For example, you would not want to have a CFO's review that's coming before a chairperson's review. And in that sense, so the flow is very important. Another thing to look out for is publishing a dual language annual report. So you want to publish in both languages. And also you should have a central theme or message. This is the main purpose of annual reporting. So you want to have a new theme, a new idea to report on year. You do not want to recycle the design. You don't want to just have a motto of the company that's on the annual report cover that remains there for years to come. The most important message of annual report is, what are you trying to report on this year? So what has your organization been focusing on? So has it been a year of high profitability? Are you focusing on sustainability? Has it been a hard, tough year where you're navigating market volatility? Whatever that was, whatever the message was, even if it was not very positive, you can narrate it in a more positive way to storytell and let all your audience know what you went through the year. And that central message is reflected not only in content, so as I said, in design. So first of all, when you open any annual report, first page, you will have the cover. So you want to have an engaging theme strapline that reflects that message. Essentially, you boil down the theme to a few captivating words that reflect that theme on the cover page. And also the cover page design should go hand in hand with the theme. And then it follows throughout the whole storytelling in the report. So ideally, you would have a theme chapter that goes into more detail about the theme. And you will have the storytelling across, which includes the design as well. And next, you will have some content guidelines. We will go more in detail in a bit, but I'd like to explain a few. So, for example, we start off with the vision, mission, values. You want to make sure you include what the company's vision is, what its values. You want to include some like a boilerplate, just standard about the company. And you want to have a year in review chapter. So what is a year in review chapter? So what are the key milestones and key achievements that happened throughout the year? They can be MOUs, they can be acquisitions, they can be big awards that you've achieved throughout the year. And we want to present them in a nice timeline format that could be monthly or quarterly based. And then you want to present your investment case. So what is an investment case? So imagine you had like 30 seconds to present yourself to an upcoming investor. How would you sell yourself? So what sets you apart from your peers in your region or in your sector? And then you want to have a shareholders information chapter, which Samah and Matt went through deeply. And in that sense, you want to present your IR calendar, your share price, share performance, shareholder classification by type, by country, etc. And you want to present your business model. So what are your inputs, value creation, and outputs? So how do you create value for your company? And at a glance. So in this chapter, it's technically a summary of all the highlights that occurred throughout the year. So operational, financial, you can even add the awards that you've won in that chapter. And then we move on to C-suite statements. So that would include the chairman, the CEO, and the CFO. And I will go into depth in the upcoming few slides. And a market overview. So in that chapter, you would just go macro to micro. You would start with what's happening globally, and then in your region, in your sector, etc. And then we have the where we operate or geographical footprint. So this really depends on your organization. So if you have global output, then we would add the global map. Otherwise, we would just restrict it to the national map, and we would cater it to where you operate. And then we have the business review. Now, the business review is the heart of an annual report. It's where the revenue is coming from. It's what you operate. So it can be your subsidiaries, your business review. It can be whatever, but this is the most important place where you want to really focus on content creation, because here is where you're narrating what you produce to your shareholders. And then we have KPIs. KPIs can be standalone in the report, or they can be linked to your strategy. Of course, it's best to be linked to your strategy. And then we have risk management. Now, risk management is part of governance, but we recommend adding risk management in the strategic report. And that would include more top-line information on risk management, perhaps even including a heat map if possible. So what are some examples for these chapters? We can start off with the theme chapter. And this specific example is from E&. So it's a UAE-based company. And the annual reporting has evolved from, simple, straightforward data fact reporting into storytelling. So as I mentioned, having a theme chapter is very important. And in the theme chapter, you want to have your theme strapline, and then you want to go more into detail and narrate what you've done throughout the year and what was the company's story throughout the year. What have you achieved and what do you want to achieve in the next couple of years? And even here, the design elements and the imagery that's chosen is very vital. So if you look at this example, you will see that even the selected image really goes well with the theme. And this is an example from Boursa Kuwait annual report for the at a glance. So in this chapter, it's very design heavy, and we want to focus on all the financial and non-financial highlights. So operational, even maybe sustainability highlights, if you want to add them here, even your awards. So you really want to focus on all your achievements throughout the year in a very highly designed manner, very top line. And next we have the stakeholder engagement. And you know that the stakeholder engagement has become of great importance. And it's technically one of the reasons why we even do annual reports. So you want to engage with your stakeholders, and you want to show how you engage, how often you engage, so the frequency, and what is the value added by engaging with your stakeholders. And even some companies take it further to add here how the board engages with the stakeholders and not only the company as a whole. And then we have the shareholders information, which, as we said, would include like the share price, share performance, shareholder classification, that would be by type, by country. And you can even add your IR calendar. And then we would add like a mock-up or a QR code for your IR website. Next would be the strategy in action, or a case study. This chapter is a very important one, and we usually try to follow a design-heavy approach for this chapter, because essentially here you're highlighting how you implemented your strategy successfully, or what are some ways, what are some things you're overcoming to make sure that you do implement it. So for this specific example, it's from Saudi Tadawul Group, and one of their key pillars is diversification. And this specific case study is about an acquisition where they acquired DirectFN, and it's a direct solution and direct presentation of how they're working towards achieving their strategy of becoming global. Now, another chapter that is becoming of increasing importance is the national alignment, or the national vision. So for example, these two are Saudi examples for the Vision 2030, and we can follow different approaches for that. You can see the example from Alimma Bank down, which is considered a more direct approach. And then we have the upper example for Saudi Tadawul Group. So for example, what is your nation trying to acquire? What is it trying to accomplish? And how are you as a company adhering to these requirements? So what are you accomplishing? What are your key objectives, goals, and how are you doing strategic decisions that help in the nation's wider goals? And then the upper example is an indirect relation where Saudi Tadawul Group is following the FSDP pillars, which indirectly follows the Vision 2030. And then we have a CFO's review. So generally, in an annual report, you first want to start with the chairman's statement. The chairman would talk about non-operational, major, big structural changes, sustainability, governance, and then the CEO would talk more operational. So what has the company achieved throughout the year and how they're working towards implementing their strategy. And the CFO continues that discussion in a finance manner. So here numbers would come in, but not only numbers that present the theme or how they're heading towards their goals, but we also want to add key trends. We want to add trends that really show that they're in line with the theme, in line with the goals and achieving their strategy. It's best to add here lots of charts, bar graphs, callouts, infographics that really showcase these numbers in a visual manner. And then we speak about KPIs. KPIs, they're key performance indicators or metrics that showcase where the company is and where it is against its strategy cycle. What is it working towards? What is it achieving to achieve its strategy? And the best way to present your KPIs in an annual report, or the ideal way, is to link it to your strategy. So you have your main strategic pillars, your KPIs, and what have you done throughout the year to get closer to your strategic objectives, and what are your goals and safeguards that are put for the upcoming years to make sure that you do achieve your strategy. And then we have the winners for the 2022 annual report that were announced in 2023 in Bahrain. And these are just some visual snapshots of what you can see in these reports and what you can notice in common. So for all of them, you can see we have engaging theme straplines and engaging covers that go along with those themes. And all of these reports have almost all best practice chapters. They have a new design for 2022, and the design was not recycled. They also have a theme strapline on the cover, and they present them very nicely with the design. And next we have the digital criteria. And digital has becoming of increased importance. And some companies even started presenting their microsites in AGMs instead of presenting the print-ready reports. So what do they have in common? Or first, what is a microsite? So a microsite is like a mini website, or it's a digital adaptation to your annual report. What's most important in a digital report is not to include all the information, but let's just stick to key chapters and key information that we want to present. And then we present them, we animate them in a way that becomes more engaging. So we try to add as much as animation as we can and dynamics for the key data that we want to present. And this is the criteria. So in general, it should be nicely designed and adapted from the print report. It should be responsive and researchable. So when you research the annual report, first thing that should come up is the microsite link. You don't want it to be buried down in your website that does not reach its target audience, and that it includes a download center. So you want a customizable download center where you can select the chapters and the sections that you want to download. And of course, it links to the company's social media platforms. And here we will have two examples of two award-winning digital reports, STC, Kuwait, and Mobily. So these two have won last year. And what we've noticed in both of them, they have a dynamic landing page. They have a very eye-catching dynamic page where they have the theme strapline on both. And they both included key chapters and summarized the key information that they want to present. They both have the download center, the navigation, and it links to the company's social media platforms. So in conclusion, design and storytelling work hand in hand to produce best practice annual reports. And an annual report is targeted to investors. So you don't want to focus on adding as much information as you can. However, you want to add information that really adds value to the investor story. And that's why we want to ensure that key messages are being presented and that the report is focused on main achievements, performance, and highlights of the year. An award-winning report is not only a regulatory document, essentially to add to your investor story. It has now evolved into storytelling, so it's not only factual, it's a powerful communication tool that makes sure you're transparent and that you engage with your stakeholders. So you can create reports not only to inform, but also to inspire. Thank you.
So we'd now be happy to answer any questions that any of you might have on the topics that we've discussed, or alternatively, on topics we haven't, and we'll do our very best to answer. Very interesting question. I think that part of that has come from the amount of disclosure that they have to disclose now, and that comes from the SEC, and in the case of the London Stock Exchange, there has been a huge amount of disclosure that's been forced on companies by the government and the Companies Act. So the trend in annual reports, particularly in Europe, but also in the US, is that they have normally two documents. Well, I'm going to say three, actually. So you have the full disclosure document, and then you have another document, which is effectively the document that we have here, which is storytelling. Yeah, and then you have a microsite as well, which in many cases is fully interactive, and you can download stuff, particularly financial information for shareholders and analysts. Great question. Do you want to answer the first?
What value are you adding to your stakeholders? Yeah.
And then regarding your second question, do you have a view on that, Summer? Yeah.
So one very important concept that we like to think about, and you probably may have heard about it before, is insider information. So when we encourage companies and encourage you as capital markets professionals to maintain transparency, we're not telling you to maintain transparency to the point that you're disclosing material inside information to the market. And like you said, there is a very thin line between maintaining your competitive edge as a company and being transparent to the point that investors will value what you say. So there isn't really a secret formula that we can share with you today, because that's not how the world really works. But it's based on the experience of the management team. So like we were saying earlier, the more you engage, the more you interact with stakeholders, the more you will start to realize and understand what exactly they're looking out for. So you will reach to a position, the more you engage with them, you'll reach to a position where you will know that you're able to protect your competitive edge and maintain your material insider information, but at the same time provide them with real valuable information that will help your analysts provide a fair valuation to your company and will help your investors understand why they want to invest in your company. So there isn't a secret formula. It comes with experience, with interactions, and with engaging more and more frequently with the market.
Okay, in that case, how to follow the regulations?
So
You're required to disclose, but at the same time, you're required to keep your own business secrets.
yes. So it's about, like you were saying, understanding the regulation. So for example, let's say if your company is embarking on a new transaction, for example, with another company. Let's say you're about to acquire another company in your industry or otherwise. Okay? Before that information becomes public to the market, that is the most critical period that you as a management team or as an IRO need to understand, because you want to tell your investors and the market all about it. But there is a certain element of confidentiality that you need to maintain until you've abided by all the rules and regulations of capital markets and are in a strong position to disclose full information about that transaction. The same goes with the concept of profit margins. A lot of companies, and I can tell you from my own personal experience with so many clients that we work with, some companies have a problem with disclosing something as simple as their EBITDA margin, believe it or not. It's the EBITDA margin. That is one of the key profit measures that your investors will look out for. One of the very famous economists says that the profit margin is actually the lifeblood of a business. How can you not speak about it? So why not talk about your margins? We're not telling you, tell us the very specific margins on every single product and every single service that you're providing. But can you put yourself in the shoes of your investor or your analyst? Think about how it's almost impossible for the analyst to build a fair valuation model when they don't even know how much margin you're making.
I think it's a subjective question, and I think every company has, in my experience, every company has a line that they won't cross. But I think as a rule of thumb, there should be analysis of every company in your field, particularly locally, see what they disclose. And secondly, because investors aren't necessarily restricted just to investing within the region, you need to look at what international companies disclose too. Then there will be a discussion about what you as a company are prepared to disclose. And already, by having that discussion, you're already going on a journey. I can't think of any particular company that has gone from disclosing very little, i.e. being practically a private company enclosed, to a company that has gone to best-in-class super disclosure the next day. Yeah, so companies don't do that. They have a journey. They go on a journey. And if you think about companies, you know, when they IPO on any market in the world, they have to give a huge amount of information. Most companies, in the immediate 2 or 3 years after that, rein back on some of that disclosure a little bit. And then, as they go forward from there, depending on what they're in, then it becomes natural evolution and what the rest of their industry or sector are doing. So I'm afraid there isn't a rule of thumb of where the line comes, but I think what one has to do is to fully understand what others are doing within the sector to really understand what you need to disclose. And that can come from one of those benchmarking exercises, because you'll see exactly what other people disclose, down to the most minute financial details. And then you have to draw a line of what perhaps you would disclose. That, together with the conversations that you have with your investors, understanding what their issues are, understanding exactly what they want, will enable you to further that decision-making process in what you disclose. So, every company will have a decision about whether they want to be in the vanguard of that journey, or they want to be slightly more competitively sensitive on that journey. Most companies end up somewhere in the middle. And that's what provides not best in class, but sufficient information for companies to invest. But
bear in mind that in all cases you have to meet the requirements of the regulators.
Exactly right. I mean, you don't have a choice about that. So that's not really for discussion. It's about the extra information that you give to help people investors invest in your company. You will find that I was talking about it with this young lady here, that there would be a very interesting piece of research that I've never seen, and if anyone else has, I'd love to see it. That measures the amount of disclosure you give and valuation, and whether there is a correlation between the two. I've not seen that.
So we are very big supporters of management guidance, just in very simple terms. So when you think about it, and when you see a lot of leading organizations, what they tend to do, and what we also recommend, and we try to push our own clients. We haven't managed to do it with the entire portfolio of clients, but we're starting to do it with some of our clients, where we really recommend them to have management guidance. Like you were saying earlier, you are essentially guiding the market. You, as a management team, are the most, well-informed people about your own business.
Exactly.
No one knows your business more than you do.
Mm-hmm.
No one knows the market in which you operate more than you do. So when you give some guidance or indication to the market, like you were saying, some companies are very conservative. They do not want to give any sort of guidance to the stakeholders in any way.
Yeah,
so like you were saying,
it's important for the other.
It's very critical. So in that case, we recommend that they give a range. So let's say for your EBITDA margin, your revenue figure, for example, your operating expenses, your capital expenditures, all of these are key metrics that will essentially drive your valuation, right? So when you give an indication, even if it's in a range, you don't even need to give a specific number, because no one is accurate.
But
100%.
it is acceptable. It is acceptable.
Not only
it is
acceptable.
Considered an insider still, or
no management guidance. If you were to ask me, if I had that option, I will ask all the listed companies to provide guidance to the market.
Mm-hmm.
Internationally, there are a number of different models about how companies report guidance. So, for example, in America, at the beginning of the financial year, the company will give a range of both revenue, profit, and EPS.
Mm-hmm.
And every quarter, they report against that.
Update.
In London, they don't have that. But there is a form of words that is put into every quarterly, half-yearly statement that gives guidance to the company, to investors. So either indicating things are below or above expectations, or meeting expectations, hopefully. And then other markets in the world are much more limited in what they say. And I think we would argue very strongly that to give investors no guidance at all, and one would always give a range, because you can't give a number because that's a profit forecast. Yeah. We would advise very strongly that investors and analysts are given the information that they need to come up with a sensible conclusion. Otherwise, your consensus range is this wide
you're lost, basically,
and totally unmanageable.
Yeah.
And therefore, when you report, you're not going to win. You just can't win because the consensus is too wide, and someone is going to be upset somewhere. So look, there are a number of models that you can look at. Guidance and certainly giving a range is pretty good practice, because it not only helps the company, but it also helps IROs and investors make decisions going forward.
Thank you.
As an IRO, you face that challenge. You want to satisfy your investors, yet your management will push not to disclose anything or provide guidance, because they will be held. They can be held accountable for these numbers.
Yes.
So it would be best if they can get away with it and not commit to any numbers. But as you have rightly said, providing a range and for the year, and then reporting against it and comparing and explaining why, whether you were within that range or not. Anyways, it's future. Nobody can tell the future. Plus the consensus you can give in your answers to the questions on quarterly basis through your script.
That's not your information.
It's not exactly. So it's a struggle for IROs to convince their management. So as you have rightly said, it's a journey. But once they see the interest of the investors and how they're insisting on that, and what we can provide and still be able to, reasonably explain, I think that solves the problem. Also, why do you need to provide that guidance? So you can. The investors and the analysts would like to build it in their model, and then they'll come up with a valuation, and they'll come up with an investment decision whether they want to invest in your company or not. Ultimately, we would love them to be investors with us. So you have to listen to what their needs and try to meet. If you want to meet the requirements, then they will ask for everything, and they will ask for your budgeting, and they will ask for your exact numbers. But again, that's forward looking, and you cannot provide that. So it's a give and take.
Just to add to that, most companies, when they're putting together their budgets, will have a base case and a stretch case. Yeah, all companies pretty much have that in today's world. The range is probably not on the base case, and it's probably not on the stretch case. It's somewhere that lies in the middle. And most companies that put out those types of earnings ranges, they feel pretty comfortable at the beginning of the year that they're going to meet those ranges. Otherwise, they wouldn't put them out in the first place. Yeah. So I think one way of getting the board comfortable with doing that is to, say, if you put out this range, the valuation on the downside is going to be less than perhaps it would be if you didn't say anything at all, and the valuation on the upside, because if you're going to beat it on the upside, the valuation on the upside has no. So actually, it's a protectionist methodology.
So remember we said earlier during the session, speak the language of your investors, speak the language of your analysts. So just think for a second how much impact it would have if the analysts that cover your company have very varying views about where the company should be valued at. Like Matt was saying earlier, imagine if your consensus estimates are all over the place. What impact would that have on your valuation as a company, right? So like you were saying, it's a real, I wouldn't say there's like a scientific method to it, but it's really an art. So as an IRO or as the management of a company, we wouldn't say own the narrative, but we would say articulate the narrative in such a way to provide adequate value to your investors and analysts, but at the same time, without disclosing information, like we were saying, that will put you in a competitively negative position. So what you want to do is really have those ongoing conversations, always maintain the dialogue with your analysts and with your investors. Think about what are the real inputs. So when you look at the valuation model of an analyst for your company, it's built on so many assumptions, right? Because they, like we were saying earlier, they will not understand your company 100%. They will not be in a position to understand the dynamics of your industry as much as you do, right?
Especially if you have like limited information to share.
Exactly. So as Dalal was also mentioning earlier, with time, you need to, as an IRO, your role is very critical because you are gauging the market perceptions, right? So through, let's say, the perception studies that you do, you will get a sense of what the market thinks about your company. So in some cases, you see that investors and analysts are really struggling to understand your company, not because your business model is complicated, because you're not disclosing enough. You're not telling them enough. You're not giving them the basic tools that they can work with. So the balance is really an art. You want to give them adequate information to ensure that their valuation will support your share price and will encourage investors to put in money in your company. But at the same time, you don't want to disclose too much to the point that you're not in a competitive position anymore. So like we were saying earlier, it's the art of balancing. It's like a balancing act, essentially. It's a thin line, exactly.
I think it is a balance, and within any company, let's say that you've got 10 sell side following you, and you've got your top 20 investors. Yeah, as an IRO, you will analyse how prioritize those analysts that are most important on to the company.
So
either because
prioritize them.
Yeah, you prioritize them. So either they come from a house that has big impact, or the individual has a very high reputation, and they will impact the value of your company more than others. So clearly of the 10, you will prioritize 4. Yeah. And at that point in time, it is about building trust with those people. So it's not necessarily about disclosing more information. It's about having that trusted relationship. So you asked how frequently. Yeah, I don't think there's an answer to that. So your number 10 analysts will have a lot less frequent interaction than your number 1 analyst, mainly because number 1 analyst will ask you more questions.
Exactly.
And you shouldn't feel shy about saying, sorry, we can't disclose that. But is there another way that I can help you? Yeah. So you've always got to be trying to move the conversation on and keep momentum in that conversation. And that goes the same for investors too. But I think it goes without saying, you should never disclose anything that you're not allowed to disclose, or your company doesn't want you to disclose, because that's insider information.
Thank you. I just want to add small information. I think it's really good whenever you have a analyst covering your stock, you sit with them, you explain the model, answer the questions, go through all of your financials together with them. They would ask you a lot of questions. So when the report comes, you can see if you are the same estimate or they beat your estimate or what to expect. And if they have something that they written that it is obvious wrong, you can correct with them and sit with them and tell them, no, this is our revenue comes from this company or from this part of the financials. So you need to engage with your research houses a lot they will understand you more, and because they know that their reports will be read by all of the market participants. So I think it's very important to engage with them and answer their question frequently, be supportive with them, make it easy to build their business model for your company, and in the end of the road, both of you guys will have the same results for the future expectation.
Absolutely right. You're there to, help.
Exactly. But you don't want to influence their assumptions though, right? Again, thin line again. So there's a thin line between giving them information that they can work with and influencing what they think or how they view your company, right? So we spoke a little bit earlier about the importance of ESG and how your ultimate goal is to report on your ESG activities, right? So there are several frameworks that companies, can adhere to when it comes to ESG reporting. But like we were saying earlier, it's not about how much information you disclose, especially when it comes to ESG, because it's such a sensitive topic. You want to ensure that the information that you provide to the market is something that is valuable to them, but it's not exaggerated, if you know what I mean. So for example, one of the key recommendations that we always provide to our clients, especially when it comes to reporting on ESG, is ensure that you have measurable and time-bound targets. These are two words that I'd like you all to remember. When you reach to a point that you want to report on your ESG, your targets need to be measurable and they need to be time-bound. So in other words, what you're trying to say to the market is that this is objective number 1, this is objective number 2, and this is by when we are planning to achieve that objective. So these are the two key things that your investors and analysts as well will be looking out for. Now, I don't feel that it's a very fair way to look at ESG reports in that manner, meaning you cannot really say that, let's say that the annual report needs to be longer than the ESG report, because what we always recommend is that quality is more important than quantity, right? So a lot of times you'll see a lot of companies adopting the practice of having like a separate ESG section within their annual report. And like we were saying earlier, within the IR website as well, they would have a dedicated ESG section where what they try to do is to give like a teaser, if you want to think about it that way, a teaser into their ESG framework. And then they elaborate much more on their ESG agenda in a separate ESG report, depending on the market in which they operate. So in the UAE, for example, the stock market regulators are pushing companies more towards integrated reporting, as you were referring to earlier. So in the UAE, for instance, companies are encouraged to develop reports that capture elements of the annual report, as well as comprehensive ESG reporting within one report that's referred to as an integrated report, like you were saying. In other parts of the MENA region, you'll see a lot of companies adopting the practice of separating the two. So several companies outside the UAE would be reporting on annual reports separately and having completely separate ESG reports. I hope that answers your question. See, we can call it what we want to call it. We can call it sustainability report. We can call it environmentally friendly report. The terminology, at the end of the day, the terminology does not matter. So we can call it an integrated report and put in valuable elements of governance on social activities, environmental, and annual report as well, such as the strategy, business model, etc. Call it what you want. But what we would really recommend as a key takeaway is, regardless of what you want to name the report, ensure that you're adhering to what the market, what your stakeholders want to read, what they want to know about your company. Either report the ESG report separately or put it with the annual report and call it integrated. Names do not matter. It's the quality of the information and the value of the information that you provide.
I have a view, and it's probably a view that is just mine. You know, I come from a perspective where, for investors, you want to have it. You know, you want to have it as easily available as possible, and therefore to have it all in one place is a good thing. And I think that will be made much easier, because all investors want to be able to do is compare one thing against the next. And the introduction of the IFRS standard, that is a global standard that is coming in very shortly, will enable companies just to report on that, and all the other stuff, all the other good stuff, you know, can either be put somewhere else. But in the integrated annual report, the IFRS stuff, which will make it easy for investors to trust and compare, it'll all be there. That's my view. I know others have different views.
So it's mostly reflected in the theme chapter, but it's very important to spread it also throughout the annual report. So having a theme chapter is where we really see what the theme is about, and we see what the company has done throughout the year and what its goals are. But we don't restrict it only to the theme chapter, because the entire storytelling of that specific annual report will be around the theme. So it will even be reiterated in the C-suite statements. It will be reiterated in sustainability, in the strategy. We will keep reinforcing the theme idea that's reflected throughout the entire report, and not only in content, even in design.
Thank you very much for your time. I hope you've enjoyed it too.